how interest rates affect spending. All right, with every loan, there's the probability that the borrower will not repay the money. To compensate lenders for that risk, there must be a reward: interest. Interest is the amount of money that lenders earn when they make a loan that the borrower repays, and the interest rate is the percentage of the loan amount that the lender charges to lend the money. The existence of interest allows borrowers to spend money immediately. Instead of waiting to save the money to make a purchase, the lower the interest rate, the more willing people are to borrow money to make big purchases, such as houses or cars, or you've even seen every time you check out at Home Depot, lumber. Just sign up and get $100 off for our credit card. When consumers pay less in interest, this gives them more money to spend, which can create a ripple effect of increased spending throughout the economy. Businesses and farmers also benefit from lower interest rate as it encourages them to make large equipment purchases due to the low cost of borrowing. This creates a situation where output and productivity increase. Conversely, higher interest rates mean that consumers don't have as much disposable income and must cut back on spending. When higher interest rates are coupled with increased lending standards, banks make fewer loans. This affects not only consumers, but also businesses and farmers who cut back on spending on new equipment, thus slowing productivity or reducing the number of employees. The tighter lending standards also mean that consumers will cut back on spending, and this will affect many businesses' bottom lines. When comparing the average dividend yield on a blue chip stock to the interest rate on a certificate of deposit or a CD, or the yield on a US Treasury bond, T-bonds, investors will often choose the option that provides the highest rate of return. The current federal funds rate tends to determine how investors will invest their money, as the returns on both CDs and T-bonds are affected by this rate. The effective federal funds rates, let's say going back to 1954, let's talk about that. The Fed lowers interest rates in order to stimulate economic growth, as lowering financial costs can encourage borrowing and investing. However, when the rates are too low, and you know what, we're going to go ahead and throw up a chart of this chart since 1954. When these rates are too low, they can spur excessive growth and subsequent inflation, reducing purchasing power and undermining the stability of the economic expansion. When there's too much growth, the Fed can then raise interest rates in order to slow inflation and return growth to more sustainable levels. Now, as you can see from that chart, when there were times of higher rates, those always led to a recession. And you can always tell that after a recession started, the rates started falling dramatically. That's really important to know. Why? Because when you see rates skyrocketing up, you know there's going to be a decrease in economic activity because there's going to be less people out there asking for money because it's too expensive, and they're going to regress. They're going to slow their purchases. They're going to slow their spending. And then what's going to happen is we're going to dip into recession. So it's really important to understand how interest rates affect spending. I hope I answered this question for you. And with that being said, let's move on to the next lesson.